Good evening, everyone. My name's David McCormick. I'm with Simmons and Associates, and I want to welcome you to the kind of part of what's becoming a series on practice ownership. So the first one last month really focused in on practice value and the buying process for grooming folks and encouraging people, the future owners. This session, number two, we're looking at practice value again, but now more so from the owner perspective as owners prepare their exit plan and how a transaction typically unfolds. My name, as it says on the slide, I'm David McCormick. I am not a veterinarian. My partner, my father, Larry McCormick, is a veterinarian. He had two practices here in State College, Pennsylvania. And in around 99, 2000, we started valuing practices. And in 2003, then we joined Simmons and Associates. So the CVA, after my name, is Certified Valuation Analyst, not veterinary acupuncture. The session that we're looking through tonight is really coming from the last 20 years of lessons we've learned and things that we feel are important that often get overlooked. So we're going to go through this. I have a little bit over an hour of content. I'll probably try and move quickly. What I recommend is sit back and listen. My email address is on the slide. You can send me an email afterwards, and I'll turn all the slides into a PDF and get that to you you can review that. And I'll attach some additional reading material to that as well. So sit back. You can minimize my image because it's not a lot worth looking at. Focus on the screen. I do have the questions open, or the chat, not the questions, but I'll watch the chat. And the way this has worked previously is when we get to the end, certainly as we go along, if you have questions, you're welcome to post that. I'll try and pay attention. I've got a couple screens that I'm watching. But when we get to the end, I will stick around as long as people have questions. So we can work through that, and depending on the timeline, we can make that happen. So first, we do need to start with a little bit of a disclosure. I have a financial relationship. I do this for a living. It's my passion, helping people through this process. I operate Simmons Mid-Atlantic and Simmons Great Lakes. So I cover 9 states, coming from Michigan, Indiana, Ohio, Pennsylvania, East, West Virginia, Virginia, Maryland, Delaware, New Jersey. Simmons, as brokers, is throughout North America. We've got Canada. I know we have members from all across, or attendees from all across North America this evening. But this is about the content. It's not about the business. So what we're focusing on this evening, I'm going to start with a little bit on practice value because there's some myths out there still on what a practice is actually worth. From there, we're going to talk about the difference between fair market value and that corporate value, and how to look at that. They are dramatically different. At that point, we're going to jump into some what I think are the key components for exit planning, considerations for you to kind of add to your head, as well as some of the mistakes and things not to do, the pitfalls to watch out for. And then, as I mentioned, we've got the question period at the end to walk through that. So let's jump in, and we'll try and make this worth your time. Practice value, let's just start there. Dr. Dick Goebel on our team, who was emeritus at Purdue and owned practices in Indiana, he found this in his collection. And Bob Lavoie, for those that don't know, was an early practice management consultant, lecturer. And I'd like to start with this because it's not that long ago, at least to me. By 1969, the goal was to build a practice that's grossing $100,000. Now, a one doctor practice, I have clients that are doing over $1 million by themselves in a one doctor practice. So it is interesting to see where we've gone from. And back then, practices did transact differently. It became, you name the price, I name the terms. Kind of like with the kids, they're going to split a brownie. One of them gets to cut the brownie, the other one gets to choose. So things are different now, and it's not in the spit and the handshake anymore. So when we say the term value, As a veterinary practice appraiser, I'm being very specific to what I mean. I mean fair market value. However, there are different standards of value. There's potential value, there's attractant value, investment value. So what I'm focusing and talking about value itself, I'm focusing in purely on fair market value. And that is precisely defined by the IRS as the price at which something will transact between a willing buyer, a willing seller, both with full knowledge of the relevant facts and neither under compulsion to act. So that's our foundation when we value a practice. There's variations on fair market value. You have fair value in partnership or marital dissolution. But in a transaction sense, that's my focus. So when I say value, that's what I mean. And it's precisely defined. Now, how historically things were done, setting that value was a rule of thumb, looking at, well, the average of the last 3 years or 1 year's gross, 30 years ago and prior. And I think practices bona fide were probably worth that, but they had a different level of profitability. There's also rules of thumb such as, oh, the average practice is 72.5% of revenue, or the one that's probably the most popular right now, 5 times the bottom line. So the problem with all of those is it assumes homogeneity within the market and that variations are not relevant. For example, takes the average practice transacts for 70% of revenue or 5 times the bottom line. Here's 2 practices, both with the same level of revenue and both with the same level of profit or earnings. Would you pay the same for either practice? By the rules of thumb, they have the same value. Does this matter? What about other impacts outside the practice? What if practice A went 1.2 million, 1.1 million, 1 million in the last 3 years, and practice B went 800,000, 900,000, 1 million? They're both grossing 1 million. They're both worth 5 times the bottom line. No, you can't do that because there are other variables involved. These days, we look at proper valuation methodology, and there are 3 ways and only 3 approaches to value. There's the asset approach, market approach, and the income approach. In the veterinary profession, we do not use the asset approach. It's great for holding companies, heavy manufacturing, new construction, but in a veterinary practice, it really is more of a liquidation value. The income approach is the traditional means of valuing the practice. Historically, that's where it's been, and we'll talk about that. And then the market approach, many people are familiar with the market approach through residential real estate, looking at comps. We're selling a used car, going to Kelley Blue Book or Edmunds.com and looking at other market data. Historically, in the vet profession, we couldn't do that because we did not have any data. However, Simmons, working with the Vet Partners Valuation Council, we've built a transaction database now that has over 1,100 transactions in it. So we can do the market approach. I'm going to share kind of some of the concept behind them. So the income approach focuses in, the term income is the return on owning the business. So the profit generating ability. That's what you get. When you buy a business, what you're paying for is the profit. As a seller, you're selling that profit, that benefit stream. The greater the benefit stream, the more somebody is willing to pay for it. You can't sell a job. When I say profit, though, I'm being very specific as far as what that means. It's not necessarily the bottom line on your profit and loss statement or your tax return. As an appraiser, the profit is the normal practice revenues, less fair compensation to you for your work as a doctor, less a fair market rent if you own the business, and no personal expenses, etc. That's the profit. Another way to think about the profit is if you own that business, but you lived on a fishing boat 4 states away, what are you going to get in the mail or deposits in the checking account? The problem is that the data you have, your tax returns, your financial statements, et cetera, doesn't reflect operational reality because it's done for other purposes out of QuickBooks, Sage, Quicken, whatever you're using, and for your tax returns. So what that means is we have to make adjustments. And for example, here's a Schedule C tax return, small animal practice, grossing almost 1.1 million. So as we have our variable expenses here, drugs, medical supplies, parasiticides, et cetera, we have our doctor compensation. There's no owner compensation on a Schedule C tax return. That's just the nature of having that sole proprietor. So we make adjustments to identify the true profit. And we can make those adjustments for two main reasons. One, non-reoccurring events. If you buy a new piece of equipment and you put the expense into maintenance and repair or drugs and supplies, you're not going to buy that piece of equipment every year. Or you remodeled the cabinetry in the lab, repaved the parking lot. Those are one-time events. So we can remove that expense. The flip side of that, though, if your partner or spouse does the books and payroll and doesn't get paid, or they do all the landscaping, that's a reoccurring expense that we have to put in that's missing. The second adjustment that we make is for operating or non-operating expenses. Personal cell phones. You breed dogs and you run those dog supply expenses through the practice. Those are non-operating. And the standpoint, way to think about that, if somebody else bought the practice, they're not going to keep paying those expenses for you. So we can identify and remove them. So we start with the tax returns because that's what's real. We can't add cash out. That we have to start with the revenues that are actually bona fide and reported. But we make adjustments. For example, expendable equipment in this practice, that was a lawn tractor. The owner's husband took care of the lawn and they bought a tractor for their home and he just drops around and does it. That's a one-time expense and it's non-operational, so we removed it. Here in doctor compensation, we looked at revenue, doctor-generated revenue, and applied a production-based compensation for the revenues from both the relief doctor and the owner. So the owner should have been paid $122,000 as an owner. We put in owner management compensation because the owner, in this case, spent a lot of time managing the managers, being the leader, et cetera, and there should be compensation for that. Because we change owner payroll, we have to change payroll taxes. CE and travel was a little below market rate, so we brought that up. Pension profit sharing, the owner's portion is considered to be a distribution of profit, so we remove that. The owner has control, so we can work through that. On the bottom half of the income statement, we have our facility costs, and then office supplies. On the tax return, the owner's being told her practice is 24% profitable. That sounds great, but it's not real. So we make the rest of the adjustments. We do have a rent expense. However, it's higher than what the value of the real estate and fair market rent in that area should be. So we adjusted that. We adjusted and removed personal insurances. We put in the landscaping, snow, lawn mowing service expense because the husband was doing that. Put in the real estate taxes in this case. The practice is considered to be a triple net lease tenant. The practice should be paying the real estate taxes. We removed personal expenses for attorney, accountant not related to the practice, removed her cell phone, miscellaneous personal expenses. In reality, this practice is 15.4% profitable. But the owner's being told via the tax return, you're 24%. So there's a disconnect, and that's a whole separate session we could talk about, managing the practice and using the appraisal diagnostics to help identify and improve profitability. So back to the income approach then. The income approach methods focus on the profit, but it's the profit going forward brought back to today's value. So that's the benefit stream, kind of using Gordon's growth model. And there's two main variables that drive that. What are the profits? And we look at history to determine the best proxy for the path forward. And then how likely are those profits to continue and grow? And that's the risk. When we look at risk, we're looking at multiple variables that influence the profit and the continuation of those profits. Some of these you have the ability to control, some you don't. But this is the appraiser comparing your practice based on all the information that's reviewed, your practice to all the other practices that have sold on the market. There are multiple methods within each approach, but the two that are most common historically in the veterinary space was the excess earnings. Historically, that was number one. That came into the profession, for those that remember vet economics, in the mid-1980s. The Owen McCafferty wrote the article and brought in the excess earnings method. The concept behind that, so you have the profits, but the excess earnings method takes the profit and says, this portion of the profit is the return on the tangibles. You bought the furniture, fixtures, equipment, x-ray, therapy laser, surgical laser, lab equipment. You should get a return on those. So it calculates the return on the tangibles, subtracts that from the profit. What's left is the excess. That's the return on the goodwill. We can capitalize that. We have the value of the goodwill, and then we add the value of the tangibles. That's how that method works. Single period capitalization in the last 20 years has really come in from outside the profession into the profession. The single period capitalization now of my colleagues on the Valuation Council, almost all of us do single period capitalization. That this focuses on, it doesn't matter taking that equipment return out of the profit, as long as you have what you should have, it's just the profit, and we can capitalize that for a value. The reason I mention this is many of you will go and should have your practice appraised. There are some appraisers, though, that take all the profit and they capitalize it, and then they add furniture, fixtures, and equipment. That's double counting. If you use all of the profit or the weighted average or whatever, all in that one number and capitalize it, that includes all the furniture, fixtures, and equipment and inventory. So you want to watch that just as an FYI in different valuations. So just as a summary note for when you go and look at the slides, and the difference between these two methods. The market approach, similar to buying a home. We go to the database and we say, okay, in the last 5 years, a practice of this similar level of revenue, similar level of profitability, where have they transacted? What's interesting in the transaction database is we had statisticians do analyses on it. What does not correlate to ownership, to value in transactions? Geography? Nope. Number of doctors? Size of the building? Number of exam rooms? Nope. The only things that correlate are the profit and the revenues. If we have time at the end, I can walk through. I've got a sample appraisal for those that want to stick around and see that. So in the valuation process, it starts by looking at the tax returns. We make adjustments, and then we can look at the income approach, the market approach methods, and then come up with a value based on that and do a couple reality tests. Sorry, phone's ringing. So we test that, and then that results in the practice value. This is called the asset value or the enterprise value. It's the value of the business. As the business value, it includes the furniture, fixtures, and equipment. It includes the inventory at normal operating levels, and it includes the goodwill. It does not include the checking account. It does not include any leases, loans, or liabilities. So that's called, and the goodwill within there. That's the enterprise value. In a buy-in situation, your associate or buyer is not buying 20% of the practice. They're buying 20% of the entity that owns the practice. The entity also owns the checking account, the emergency fund, responsibility for leases, loans, liabilities, payables, etc. So that value of the entity is called the equity value. You can think of equity as net worth. The sum of what you own less what you owe is your net worth. That's your personal equity. The same is true for your business entity, your corporation or LLC. The sum of what it owns, the practice, the checking account, emergency fund, less what it owes, the liabilities. Assets minus liabilities equals equity. That's the value of 100% of the shares. Another way to think about that, for those that have seen me before, this chart might look familiar. We didn't have time to go through this tonight. But the asset value, the enterprise value of the business is those tangibles and intangibles without the cash. Cash stays with the seller. In a buy-in, we're looking at the whole. And that's done on the balance sheet. And the balance is assets equals liabilities plus equity, or moving liabilities over, assets minus liabilities equals equity. So it's just an extra step in the process. Coming back to the profit. Profit, the other term that's out there is called EBITDA, and it's become more popular lately, especially with the corporations. They like to use that term. That is essentially the profit. The acronym EBITDA stands for the earnings, or the bottom line, the profit, before interest, as if debt-free, before taxes are paid, which most entities don't pay corporate entity level taxes, before depreciation and before amortization. Depreciation is writing off tangible purchases. Amortization is writing off intangible purchases. They're both tax entries. It's not real dollars spent. So that's the EBITDA perspective. Now, I mentioned practice profitability, and the one I showed you was 15% profitable. Here's the reference point. So if you think about the bell-shaped curve, right? That hump in the middle, the average practice of any size and any type is 10 to 12% profitable. To me, that's a little bit scary because that means half of all practices are about 10, 11% profitable or less. That's a problem. We consider a practice to be financially healthy if it's 14 to 18%, and that's coming down the right-hand slope. You get out into the tail, and then you get practices that are bona fide 19, 20, 21, 22% profitable. And those are the ones that are worth 1 year's gross. It's uncommon in our experience in valuing practices, both for transactions and management and planning purposes, 1 in 20, 1 in 25 practices can hit that. I valued a $13 million grossing small animal practice that was 0.6% profitable. Size doesn't matter. It's the profit that matters. And that's where having that valuation for diagnostic and management planning purposes help. So, but that's another topic, maybe the next in the series. So fair market value is everything we've covered so far, but now we've got the corporate side. So let's dive into that for a quick spin. Fair market value, as I mentioned, we can quantify that. We know precisely what that value is when the appraisal is done correctly, or the valuation. Investment value is the swimming pool the corporates swim in. So fair market value buyers can't go into the investment value realm. Investment value buyers can swim in either pool. Investment value is different because it's a price to that buyer. How much do they want to pay? This is also called synergistic value because the buyer's bringing synergies with them. Thus, they're willing to pay more, perhaps, than fair market value. We can't precisely quantify that because it varies by buyer and by object being purchased. However, because we have experience in the market, we can get a pretty good idea of different buyers and what their experience has been and what they're willing to pay. So we can look at that. The other difference when it comes to these transactions, of note, at least difference of note, because there are a lot of differences, In a fair market value transaction, it's typically cash paid at closing. There might be a seller note involved depending on the lender, and we'll talk about that as we keep going. In the investment value transactions with corporate, there's a lot of options. Certainly there can be cash. Some will pay 100% cash. Some will do so much in cash, so much is in a note. Some will do an earnout. An earnout meaning I'll pay you this much at closing, and then if your practice revenues hit X, I'll pay you this much more. It can also be equity. In other words, the corporation might buy 80% of the practice and give you 20% in shares of the corporation. There can be delayed compensation structures. There can be things involving with the associates, lease terms, tax planning, etc., that can come into play in that. One of the ways to quantify this, dollar-wise, and the difference. So the phrase 5 times the bottom line, right? It's not every practice is a 5. Most are probably in that 4.2 to 5.5, maybe up to a 6. Investment value, that synergistic value, corporate transactions historically, like back when Dad sold his practices, the multiples were 6 to 8, maybe a 9. Now, what do you negotiate? 9, 10, 11? I recently did a 12, a 15. It ends up being negotiating that because the first offer is not the final price. That's just the start of the conversation. So that's why many of your peers and colleagues that you talk with, oh, they sold and I got X. Well, comparing multiples is I got 9 times, I got 11 times. Oh, I only got 7 times. Comparing multiples is a mistake because that's like new graduates comparing their compensation. I got 21% production. Great. Oh, I only got 19. But what counts towards production? They don't talk about that. Same on the multiples. Every corporation will come up with a different EBITDA for your practice. That's why when the corporations present their offer and the ones that say, oh, well, this is how we came up with it, I start laughing. I don't care how you came up with it. That's your side. What's the price? That's my client's side. Your math doesn't have any relevance. Now, the 5 times the bottom line, it's a way oversimplified. It's kind of like you describing a spay. Well, you knock them out, cut them open, take some stuff out, close them back up. It's a little more involved with that. And same with not every practice is a 5. But it is a handy reference point when we're talking about the money. Because the fair market value, 5 times the bottom line, what that's saying is that the buyer is giving you the next 5 years of profits today. When you have your practice valued, you're going to look at that value and say, well, if I keep my practice, I'm going to make this much over 5 years and I can still sell my practice. That's true. That will always be true. So the reason to sell is you don't want to do the work, so somebody's going to give you 5 years now. In the corporate world, let's say a 10 times multiple, you could sell it for 5 times, or go to corporate and sell it for 10 times. That's a nice pile of money. And that's why many people are falling for that. However, they're forgetting to look at the goals and time. Because if your goal was, well, I'm not going to sell, I want to work for 8 more years. Okay, well, what if you keep the practice for 5 more years and then sell it? Well, in that scenario, you keep it for 5 years, you get 5 years worth of profit. If you sell it for 5 times the bottom line at that point, you got a total of 10. And each of the 5 years you owned it, ideally, we hope the profit was going up and you had control. You want a new set of rigid endoscopes, you go buy it because you have control. Versus working for corporate, oh no, I'm sorry, that's not in our budget this year. So what I often recommend is if you take the big money off the table, what's your plan? And we're going to talk about the plans coming up. So I do want to address a couple of other corporate things, and we'll have time at the end. But some of the corporate folks are out there saying some of these things. Oh, well, yeah, you better sell corporate because your associate can't afford it. Your associate can afford it if it's fair market value. They can't afford it if it's investment value. That would be like paying $30,000 for a $10,000 car. You just don't do it. There are also comments out there that I get from clients saying, well, they told me that this bubble's going to go away. These high multiples are going away. Folks, that flies in the face of Economics 101. You have fewer large practices that the corporates want, and you have more people that want them. Supply, demand, yeah, that's not going away. Now, it can change. If interest rates start going sideways, and we had a big challenge last year, it impacted some practices, didn't impact other practices. In fact, I had spoke with a client tonight, they're still up 20% year to date. So, but that high multiple is not going away. So no sense rushing. And the other myth that I like, oh no, we'll buy your practice, everything's going to stay the same. No, it's not. There are changes that are made, and to watch that. So kind of keeping your eyes wide open with these. And I'm hearing more and more, oh, well, my colleague or member of this group, they sold and they recommend I really work with, or your reps or vendor reps, oh, they're really pushing for this. The reason all of those folks are pushing for it is the corporations are paying finder fees. So they get a kickback, a referral fee, if you end up selling your practice to fill in the blank and they were the source that made it happen. So just kind of watching out for some of those. I do a lot of corporate transactions, we all do, but I am a big fan of, like Mama said, date many, marry one, because there are a ton and they are all very different in the details and what they will do, what they won't do, and how those structures work. So if you're going to go that path, don't marry the first one that comes along. I think that's pretty important. And ideally, you set a plan up first. So let's talk about exit planning and some of the things to look for. So in preparing, some of the keys, one of the things I think it's important to start with, who are your potential buyers? Who's going to make the exit happen? Because this can impact your target timeline. So within that, is it your associate? Is it somebody from the market, fair market value buyer? Maybe they're not working there. Maybe they're going to move, which is not always likely. What about a corporation? Can you find a corporate match? They need you to stay after closing. You have to stay at least usually 1 year, sometimes more. Occasionally you can negotiate less. What about a merger? So if you're a smaller practice, that could be a viable opportunity. That's win-win. The acquiring practices, their clients are already paying all the fixed expenses. So your revenues come in. The only expenses that have to come out of that, doctor compensation and the variable expenses, drugs, lab, parasiticides, pet foods. The rest of that drops to the bottom line. What if no one is going to buy? And giving thought to all of these, especially with the considerations to geography and your type of practice. When it comes to putting a practice on the market, geography is far and away #1 variable in how long it will take to sell. And the next variables aren't even close. It's an order of magnitude over. What I mean by geography, within each state, there are popular areas. And if your practice is not in the popular area, it might take a while to sell. It doesn't matter that it's a great location, fastest growing county, low cost of living, perfect for a married couple, partners. None of that matters. Geography is there someone that wants to live there? Very few buyers will move for an ownership opportunity, which is different than what I expected. When Dad started his first practice, he picked the family up from Ohio and moved us to Pennsylvania because it was the right size dot on the map. Now it doesn't happen. About 1 in 10 of my transactions, the buyer's actually moving. I just had one that moved from Colorado to Michigan, but that's uncommon. And so if you're not in a popular area, you might need to start your exit a little early because it could take 1, 2, 3 years, 4 years to find a buyer that wants to be there. And if it sells right away, darn, but it sold and I didn't run out of gas. Time on the market does not correlate to value, unlike real estate. As long as you keep the practice healthy and trucking right along, your value can maintain and continue to grow. But if you start doing this, running out of gas, then your value is going to come down. But that might be okay. And I did have a practice owner. We couldn't find anybody to move there. So we went from 5 days a week to 4 days a week to 3 days a week. It gave me more time to try to find somebody. Value was coming down, but he kept the practice open. He loved doing it. He wasn't living on his retirement yet. So he had the cash flow. And ultimately, I've had ones that, yeah, we found somebody right at the end, great. And others that we didn't, they had to close. But at least they closed knowing they did their best and had us, we did our best to try and make it. I hate when practices close because there are usually good practices, but it's the power of that geography. I had a practice that was free. It was grossing 500,000. The fair market value was 250. It was free if you bought the real estate for 250,000, which was over 10 acres. Nice building. Nobody would move. If that practice was an hour south, I could have sold 5 of them, but nobody would move up. That's geography. Related to that is the type of practice. Most buyers want a traditional general practice that's in the location where they want. If you are a specialty practice, a holistic practice, a mobile practice, and large animal, mixed animal, equine, then you're taking that pool of buyers and you're getting to a smaller and smaller subset of potential buyers. Or you're a practice, and I spoke with one doctor earlier today, he's grossing about $300,000. That's definitely sellable. The smallest one I sold, the value was $75,000. So up to 24 million. The smaller practices, solo practices can sell. Geography plays a role. Revenue can play a role because most of the buyers have student debt. Because of the student debt, they need full-time employment. Full-time employment comes when you have a practice that's grossing about $450,000, $500,000. So if you're smaller, you're looking for buyers now that don't have student debt. It's possible, but it's fewer of the potential buyers, or they have a partner or spouse that has enough cash flow to cover that. So these are some of the variations on this to give thought to as you start looking at the timeline. Coming back to the top on the associate, talk with your associate and say, are you interested? I've spoken with some of my clients and they say, oh no, my associate's not a future owner. And then I go to my database of buyers and they're there waiting for a practice. I can't tell them because of confidentiality, but talk with your associate if you have one. Other assessments. Are you ready to sell? Can you take the hat off, the captain's hat off, or are you control? And you got to have it my way, because that's going to make for a harder transition. What are you going to do afterwards? Yes, okay, your buyer's going to keep you there, but what's plan B? It hasn't happened to me, but I've heard the anecdotes. Oh yeah, the buyer was going to keep me, had a year of contract, fired me the day after closing, and their classmate came and joined them. Okay, what's plan B? Have you met with your accountant and your financial planner? Can you afford to retire? And keeping in mind, if you run a lot of perks through the practice, health insurance, pay for your car, pay for your cell phone, pay for pet supplies, once you sell, all of those expenses are coming back to your household. Also looking at the different exits. They don't all have to happen at the same time. Exit from owning the practice versus being the doctor. If your partner or spouse is the manager versus landlord, those can happen at different times, or do you want them to happen together? Because then you need to plan accordingly. And on the partner spouse issue, do involve them, please. I had one transaction. He was selling his practice. His wife did not want him to sell the practice, would not talk to me. If I rang, she'd recognize my voice and just, it's him. So involve them in the decision. This is a life-changing event for the entire home. So you want to make sure everyone's involved in getting through this process. Some of the things to do. So as you're approaching your exit and during the exit, report all of the income. Now it's less prominent and frequent these days, but historically it was more common to take that cash out. Don't do that. I can't put it back. The lenders won't accept it. So start reporting everything. Document the perks, because as appraisers, we can make that adjustment. That doesn't mean the buyer or the lender will give credit for that. So if needed, it helps to have that and understand that. Keep your fee schedule current, keep the maintenance up on your vehicles. If you have an ambulatory component, on your equipment, on your facility, make sure things keep trucking along. Don't let that deferred maintenance creep in. Make yourself unimportant. So what I mean by that is delegate, trust but verify, but have other people. The less important you are, the easier it is to take you out and put another doctor in. It makes for a much smoother transition. Some of the other components through the stability, things not to do, don't hold the practice too long, because then it starts coasting and dropping off, or expressing extra appreciation to the staff, overcompensating them. We can't take that away. So that drops your value. Also, don't assume you have value. This is not the opportunity to do what your clients do, Dr. Google themselves, right? Don't do that to yourself. Bring in a specialist, a veterinary practice appraiser, to determine the value of the practice so that you can make decisions based on data, not based on estimates. So related to that, once you have the appraisal done, sit down with the accountant and say, if I sold today, what would my taxes be? And if they say, well, if we estimate this much for inventory and this much is, no, stop them right there and say, no, I want this on letterhead. Oh, let me get back to you then. You want them to sit down and do the math and determine that number, because the taxes, I like to be conservative fiscally. So I like to take about a third off the top. Yeah, capital gains, okay, 20%, then maybe 5% for the state. That's only 25. I want to be conservative. I'd rather have more left over. But you need to look at that as you go forward. Also, I don't recommend adding equipment right before you exit. So yes, people like digital, but if you don't have it, it doesn't make sense to add it and sell, especially when it's like selling your home and going and remodeling the closets. It's not going to add value. Just because you have digital x-ray doesn't make your practice worth more. Now, if you add digital x-ray and you use it for a couple of years and it generates more revenue, which results in more profit, that increases value. But simply having it, no. And try and avoid those reference lab agreements. So I'm going to come back to that, but I wanted it in both locations. So do not do those as you approach your exit. We'll talk about that a bit. As I mentioned, stable staff, don't give gratuitous raises, and don't deplete the inventory as you into the closing. Remember, the value includes normal operating level of inventory. If you drop that, then the purchase price is going to be adjusted at closing. So you might place an order for Hill's order the week before closing. And yes, that invoice is yours. But you need, if that's what's normal, that's what you do. So, and be open. Everything's going to come out in this transaction. And there's a lot of trust that needs to be involved. So the more open you can be, the easier it's going to be for the buyer, the seller, the staff, the clients, the community, etc. Some of the things to watch out for, coming back, here's this lab agreement. So the lab agreements come in a lot of different flavors, whether it's special pricing for the reference lab, or you got your digital system or lab suite of equipment um, in exchange for the commitment to use that company for the next 5, 7 years. You know, they're great. I like them for when you're going to own the practice for a long time, for a while. The problem when you go to sell and exit considerations is that, yes, the reps say, oh, don't worry, it's transferable. And they are, if the buyer wants it. If they don't want it, you have to cancel it. And that can be very expensive. So I've had scenarios where the practice had the agreements with this company, and the buyer came in and said, no, I understand. I don't like that equipment. I want this equipment. And I'm already working on that agreement. To get out of this agreement was going to cost the seller $80,000. And I've had it as high as $400,000. So if you can avoid those agreements, whether it's special pricing or the coupons, and if it's coupons and you've used them all, then the buyer's taking on the obligation without any benefit. So the exception to this is if you're selling internally, your associate already is aware, is using the equipment, that's fine. We have continuity. But otherwise, you need to watch that because it can be a problem when it comes to a transaction. You can't, some buyers will just accept it, and we try to force it on. The purchase includes assuming this relationship, but it can be a challenge. The other component to watch out for, lab agreements and buying groups. There's a couple of variations on these that we're starting to see, and it's creeping in. Number one, the terms are getting longer. Number two, they have automatic renewal. So please, please really read these agreements. And don't just let them say, oh, this is what this means. No, sit down and read it and have your attorney read it, because we're seeing some with personal guarantees, which means even if the buyer assumes that relationship agreement, you're on the hook personally to guarantee it if they don't follow through on it. And in that case, they had no clue. The automatic renewal, that if you don't give notice 12 months, 24 months, 36 months before the end, the obligation renews and you get no additional benefits. What I recommend in that case, if you're going to sign that agreement, have that I am not renewing this letter right next to it and give it to them and have them sign it right then. If you didn't do that and you have one of these agreements tomorrow, I would send them a letter saying, I am not renewing this agreement. Please document receiving this letter and add that to that agreement. Do it now so that you don't forget. And the scary one that we're seeing, as this just came to light today, so this is some of the latest, at least it came to light to me. There are some organizations that are putting into these agreements that you sign that gives them the right of first refusal on your practice. And this is where the corporations and the relationships are starting to come through and need to watch that. Now, it's not common yet, and my hope is it doesn't become common. But why would you give someone right of first refusal? They're burying this in the contract because you're not reading the contract, but then they're going to hold you to it should they find out you're selling. And then you might be forced into selling to somebody you don't want to. So read these agreements seriously. If you have one, go back and read it tomorrow or this weekend. Make the time to sit through that. If you have questions, give me a call. So exit itself. 3 years before, I recommend you value your practice and you value the real estate so that you can make decisions with the data and plan accordingly. I also recommend do a building inspection. So have that building inspector come, walk through. That's going to give you that big report of everything that needs to change. You've got 3 years to start fixing those. The buyer's going to do one. And if everything's fixed, their inspector is going to come in and say, well, this looks great. As opposed to here's a laundry list and now we have to negotiate some kind of mitigation. So going through that gives you the data and the time to fix things. So then you can then meet with your financial planner, planning for the accountants and taxes and retirement. Related to that, on determining the practice value, if your value is low, you've got 3 years to start working to fix it. Because if you had a veterinary practice appraiser do that, they're going to be able to give you feedback. We call it an appraisal for management and planning purposes, because we give the feedback of that adjusted income statement for me is like you looking at a full blood panel. You see what's off, and not because it's color coded these days, but you know what's off just by the numbers. And it's the same for us. That's my diagnostic tool, is an adjusted income statement. On valuations, because I realized I didn't put a slide in here. And I'll put one in for the PDF. Most valuations are going to probably run $3,000 to $5,000. When it's being done for planning purposes, you want to tell them that. It's not that you want the number in the report. You want, what did they learn back from that? So I do recommend the Vet Partners Valuation Council as a resource. There's 25 of us, names you recognize: myself, Sherry, my father on the team, Jim Stevenson, Karen Felstead, Denise Tumblin, Tom McPherson. There's a lot of them, and they're all excellent. So as a resource, I think that makes a lot of sense. I did see a hand raised, but I think you can, people are using the Q&A instead of chat, and I don't have Q&A open. I apologize. I'm going to save some of these to kind of run through. Yes, you can get a copy of the presentation. Just send me an email. It'll be on the last slide as we get to there. The sim and sell practices of corporations, we can represent folks for that. But we also do valuations purely for management and planning. Buying groups, when I use that term, that's where you sign up, you join the group, you get special discounts depending on what you order, and special pricing. So and there's a bunch of different ones. Appraisal and valuation are synonyms. So now an evaluation, that's different. That's a practice management consultant that's coming to observe your practice, workflow, review fee schedule, job descriptions, where they're doing a more comprehensive. But a valuation is an appraisal and determining the value. Real estate we're going to come to as we go through there. So let me move the pointer out. There we go. So, and through that, also post-sale. So that's where the plan starts at 3 years before. The year you're going to exit, now you update your value. For the practice, you update the value for the real estate if you're going to sell it. We're going to talk about that. Then you put your plan in motion, whether it's putting it on the market, starting to work with the buyer, etc., and looking at the financing, bringing the attorneys into play. We're going to talk through these once we explore the transaction process. Typically 2 to 4 months for the transaction. If it's practice only, it can be 2 or 3 months because there's no real estate and extra steps to that. And then we have closing and we're into the transition. So once you say, yep, I'm ready to go, and the buyer makes you an offer and you accept it, that's when the clock starts for that 2 to 4 months. I've had it be shorter and I've had it be longer. Some of that definitely depends on how well the attorneys play together. So as a walkthrough on the transaction, we're ready to go, you have a buyer. It is my opinion, first, the price. Then we're going to talk about financing, we've got contracts, and the transition. On the price itself, my recommendation, and this is what the buyers are hearing, I don't change what we say based on who's listening. It's the seller's responsibility to set the price. You do that by having a practice valuation done, practice appraisal. They determine the profit and they determine the value then. It's the seller sets the price. I talk with buyers and they say, oh no, the seller wants me to go have an appraisal done. No, definitely not. They could have the best appraiser in the world who's never wrong do the value, but it's going to come back and be lower than the number that's in your head. statistically speaking. And you're going to not believe it because, well, of course it's low. The buyer's appraiser did it. So what I recommend in that scenario, I tell that buyer, go tell the seller they need to have it, they need to pay for it and have it done. Now, you could split it, but the buyer's going to say, I'm happy to share that cost with you. I will reimburse you at closing. And part of the reason for that is that if you haven't had your practice valued before, you're going to find out it's low. Then you're going to turn to the buyer and say, I can't sell it to you right now. Let's sell it to you next year. I got things I need to fix. They shouldn't have to pay for your management consult. One question relative to this, a 1 or 2 year old valuation, is that going to be sufficient? Somebody's going to get the short end of the stick. I would say no, because if practice revenues went up and the profit went up, the value went up. If revenues went up and expenses went up, the profits went down, the value went down. In both cases, nobody knows. Now, the lender is going to do an analysis, but you don't want to leave money on the table or start off with something that's not going to work. So I do recommend updating the value. A Simmons update, or not Simmons, a valuation update, adding 1 year or 2 years usually is less expensive. So do you use the same appraiser for the valuation of the practice and the real estate? No. Real estate appraisal is different. And that is more local market driven. So in doing that, you want to engage a real estate appraiser, commercial real estate appraiser, or you can estimate the value working with commercial real estate agents. Buyer tests the price. It starts in the same place. It does the profit, but then it says, will the profit pay the debt and pay the taxes? If that's true, it's fair market value. If it's not true, now we can negotiate based on the facts. So there's more information on this in the first series, the first that we put together. So the buyer tests it. Once that's set, now we bring in, the buyer's going to go to the veterinary lenders. So we're fortunate in the profession that we have veterinary specific lenders. These are cash flow lenders, whereas local banks tend to be asset lenders. They loan up to 80% of the value of the home. Whereas cash flow lenders, will the profit pay the debt? If so, they're perfect. The terms these days, which is pretty common, it's a 10-year term on the practice, a 20-year term on the real estate. There might need to be a seller note depending on the value of the real estate. So commercial loans often go up to 80% of the value. Some lenders can work and find a way to cover the other 20. Otherwise, you might have to cover that 20, which ends up being 10 to 15% of the total. So 100% cash is possible, but be prepared that it might not be. Once the buyer knows they can get the money, now we're moving into contracts. And for this, I strongly recommend working with a veterinary attorney. If the buyer does not have one, usually I like the buyer to have the veterinary attorney because that attorney provides a lot more coaching to them through the entire process. If they don't have one, then I recommend you as the seller have one. Not family, not your old shooting billiards buddy, somebody that does this for a living in the veterinary space. If you're doing a corporate transaction, most definitely a veterinary experience, because the corporate attorneys do this all day, every day. You want somebody that's gone to that battle before and knows what those parameters are. The buyer's attorney is going to prepare the letter of intent. The letter of intent's the formal offer. And that goes back and forth because there's always things to refine. So I had a call right before this with one of my clients to review the details in the offer and some of the edits that we wanted to apply. Once that's accepted, the buyer's attorney is going to then prepare the practice purchase agreement, called an asset purchase agreement, and then the real estate purchase agreement. And those start going back and forth. Once the letter of intent is accepted, the buyer then is going to commit to one of the lenders and write the check. The lender is going to order the real estate appraisal. So everything starts falling into place. Much of the timeline depends on how long it takes for the appraisal, how well the attorneys play in the sandbox. And they start throwing sand, that adds time, which adds money, of course. And then when the bank is ready. When all three of those are ready, we can schedule closing. So the closing date is in the letter of intent, but recognize that that's a target, it's not cast in stone. So overall, as I had mentioned, the 2 to 4 months once the offer is accepted. Now, some of the details, and some of this, I think I'm looking at some of the questions as they pop up. I think this will hit some of this. Other details through here. The purchase price allocation. So the determined value, as we talked about, includes the furniture, fixtures, and equipment, the inventory, the goodwill. It includes a non-compete covenant, usually 5 years and 15 to 20 miles, depending on geography. For tax purposes, that purchase price has to be split into those piles because each one of those categories is taxed differently. And so the purchase agreement needs to have those amounts in it. And that's a significant step during the process. The other component on the taxes, you want to give thought to the timing. If you close in December, your taxes will be due in April. If you close in, not December, let's wait a week and close in January, your taxes are not due until April of the following year. So sometimes there can be benefits to delaying a little bit, depending on how things are going to unfold. If any of you are a C corporation, as a side note, which means if you open up your tax return and in the top corner it says 1120, you need to send me an email. We'll schedule a call to talk. You've got some tax issues coming your way. It's uncommon, fortunately, knock on wood. But if you are an 1120, we need to talk. If you're an 1120S, you're fine. But an 1120 pays entity level taxes, which from year to year, that's fine. But when you sell, there's a big consequence coming. So other variations in some of the details. Real estate, should you keep it or lease it, or should you sell? And on the buyer's side, the rent the practice pays the mortgage. So they want to own it and not lease it. You want to pay your mortgage or do you want to pay someone else's? From your side, as a practice owner, the consideration that I like to mention, yes, that rent looks good. It's nice cash flow. But the litmus test I use, if the buyer moved the practice because they grew, because they found a great opportunity, can you find another tenant? Non-veterinary, because the buyer's going to put a veterinary restriction on there. If you can find another tenant, another use for it, or maybe Starbucks wants to buy your real estate or long-term lease it, if that's the option, then I think you're fine, lease it. But if it's going to sell vacant, it's going to be hard to sell, then you're better off selling at closing. If you want to maintain your investment in real estate, you can do what's called a 1031 tax exchange. What that means is you can sell one commercial real estate and buy another and roll the gain into this so you don't have to pay the tax on it. There are a lot of rules to it, but that other commercial real estate, that could be farmland if you're going to farm it or lease it to be farmed. It could be a rental property, a single family home. Dad, when he sold the second real estate, he bought a property up in New Hampshire as a rental property, rented it for 5 years, converted it to personal. And it was he and mom's second home. So there's a number of options there to look through. Meeting the staff. Typically, this does not happen until a week, maybe 10 days prior to closing. There are exceptions. I do not like informing the staff the day of closing or after. There's a couple corporations that like that, and I've had some buyers do it, or a seller that wanted it. That's not good. Or telling them too soon. If you're selling internally, you don't want the staff to know anything until you're a week or 10 days before closing. So you never have a conversation in that practice when other people are present with the associate, in my opinion. You need to protect that, keep everything on the down low until it's real. After closing, a client letter is sent out. I'm a big fan of the client letter. So on one page, one side of the page, it's a letter from you. On the other side, it's an introductory letter from the buyer. It's a warm, fuzzy touch as opposed to a cold, prickly of a reminder card. So it's happy. We have photos and we have you saying, thank you, I've loved being your other family doctor, and blah, blah, blah. And on the other side, I can't wait to come join the team. And it's goodwill generating. I have some transactions where they just don't do it. It's an internal transaction. They don't want to announce it. But it's something to definitely give thought to. If you have an entity, an EIN number, usually you keep that for 2 or 3 months, 4 months after the closing. Settle out all the payroll taxes and other details, and then you can kill your entity or repurpose it and use it for something else. On some of the closing and transition, once the closing happens, the majority of your vendor supplier accounts are going to get canceled. The buyer opens all new ones. And the buyer should wait and open them right before closing because they get new account discounts. You close your insurances, you'll get refunded unused portion. Buyer's going to have all new insurances, new employee benefits. We got to transfer controlled drugs. So we've got the DEA license and the logs. Your logs have to leave with you unless you're going to stay and work. Post-closing, are you going to work there? That's a discussion to have with the buyer as part of your planning. Do you want to? I do like when the seller's willing to work a day a week. Not that the buyer gets a day off. They're not golfing. They get a day on. They can be there in the practice working on the business while you're there working in it as a doctor. I like when that happens. It helps the buyer with time management. Much of that, though, depends on the relationship between the buyer and the seller. So the common pitfalls, and these are not rocket science, unrealistic expectations. I get folks that contact me in November to have an appraisal done and they want to sell by the end of December. An appraisal, as I mentioned, going to cost $3,000 to $5,000 with most veterinary appraisers. It can be more, it can be less. Stay away from the free ones. You get what you pay for. But once we have the data, for us, it takes about 6 to 8 weeks to do the analysis, let alone negotiating an offer. And once an offer is accepted, it takes 2 to 4 months to complete the process. So you need to set appropriate timelines. Unreasonable demands on the buyer or the seller. Oh, I want this, or you're going to keep paying my insurance, or I have, you're going to let me bring my pets in for free, or I get to board anytime. Well, some of that has to be negotiated, and be flexible on all of this. The do-it-yourself approach, bringing in advisors vaccinates the transaction. If the transaction goes south, it's going to cause problems for more than just the buyer and the seller. And you end up with litigation, or it impacts the families of the team members. There's a lot that can happen. So paying attention and trying to keep things even and equitable for everyone is going to be a successful transaction, in my opinion. So stay away from verbal, get it in writing. And these are all no-brainers. And working with those advisors, Vet Partners is a great place to start. Vet Partners is a consultants association. There are veterinary practice attorneys, lenders, architects, financial planners, you name it, practice management consultants, HR consultants, mediator specialists. They're all veterinary specific, committed to helping you in the spaces you need. If you are seeking appraisers or you're seeking attorneys, contact a nearby broker or send me an email. I always make at least 3. I can send you 3 references for attorneys, lenders, appraisers other than me. I do think it's important not to say, oh, I'm just going to hire this person because I saw them speak, or I wrote that they read the article. Talk to a couple of them. You're paying for advice. You want to make sure it's worth paying for. And so do look around and not just jump on the first one that comes along. Vet partners within that is evaluation counsel. And as I had mentioned, that's my go-to for appraisers that know what they're doing. So now I've opened up for questions here. I'm looking up my upper monitor, so sorry I'm not looking at you right now, but I'll look through some of these questions. Oh, wrong mouse. Selling a house call practice, hard to do. I have done them. It's hard. What's hard about it, though, is finding a buyer. It's like selling a holistic practice, a cat practice, because our pool of buyers shrunk. Most of the potential buyers do not want, or they want the typical traditional general practice, brick and mortar. A house call practice can be exceptionally lucrative. I tried to sell two. I sold one. I couldn't sell the other. And I have one for sale now, and it's unknown. So in that case, same as an equine or a large animal or a mixed animal practice, one of the things you can do in planning your exit, groom your buyer. If you know it's going to take a while, then create your buyer. Bring on an associate who's going to be the one to buy you out. What is the average percent for a broker representing the seller? It varies. Most tend to be 6 to 8%, somewhere around that, practice and real estate. Sometimes for me personally, if I have an identified buyer and I'm just facilitating the transaction, then it's 5 or 6%. But that's something definitely to discuss. I'm going to run to the top of these questions and try and run down, make sure we get all of them. If you do want the presentation, let me, oh, I moved. There we go. My email address is here. You can send me an email. I'll turn this into a PDF as I mentioned and send that out. Don't request it in the chat because I won't have your email. I don't do anything else with the email, and I don't charge for phone calls and emails either. So there will be a copy of it. 1 to 2 year old practice valuation we did talk about. I think you do need to update the value, especially on the practice, maybe less so on the real estate. Oftentimes for the practice owners, I don't necessarily recommend having a real estate appraisal done. If you do, the bank is not going to be able to use it. They're going to have to use their own. It has a shelf life and it can be fairly expensive. Oftentimes, instead, we'll work with local real estate agents to have them determine an estimate of value. To do that, what I recommend, many of you have clients that are real estate agents, so you can contact them and say, hey, I have a question for you. We're doing some estate planning and financial planning, and my advisor really wants me to update the value of the practice real estate. What do you recommend? By framing it that way, they're not thinking you're a potential client. So they're just happy to help you. It might be free, it might be $200. Once you get somebody that says yes, what they're going to do is they're going to go back to the office and look for comps. So what you want to follow up with, and I think if you engage an appraiser, you want to do this as well. What I've heard is when you look for comps, do not look for other veterinary practices. Look for professional office space. Veterinary real estate is not worth more because it's veterinary unless it's new construction, less than 5 or 7 years old. By looking for professional office space, they're more likely to find comps in your market. So dentists, architects, attorneys, chiropractors, human medical centers, they're going to come back with a range. We can work with the range. And oftentimes, like I said, that's free or inexpensive. Is it wise to get the practice value 1.5 years prior and again the year of sale? 1.5 years, when we value a practice, we're typically looking at a calendar year, so December 31. And then that value is used for the full year anytime. So the values I'm completing right now are December 31, 2020, and we'll use that to transact maybe in November or December. An exception would be if a practice is growing like this or something, we might look at the period 12 months ending June 30th. assuming the data is very substantive and reliable. So you can do an interim valuation. What should you expect to sell or cost for evaluation? Typically 3,000 to 5,000. That's completing what we call a summary letter report. And it's maybe 5 to 10 pages. It's not the 50 to 70 page report. That I charge $20,000 for. But we only do those maybe once every other year. How is fair market rent determined? You can engage a commercial real estate appraiser to do a determination. If you're going to keep the practice or sell the practice, keep the real estate, might be worth having a third party determine the rent. In valuing the practice, we often look at 8, 9, or 10% of the value as an annual return. If your real estate's worth $800,000 and we use 9%, that means the annual rent, base rent, would be $72,000. It would go up 2% per year. List of veterinary attorneys, certainly through Vet Partners, or send me an email. Selling, that one we did. S Corp, that is better than a C Corp, most definitely. There's no entity level tax that you have to worry about. LLCs, S corporations, sole proprietor, partnerships, those are fine. It's only an issue for C corporations. How do you manage the transition of accounts from the old owner to the new owner? Is there some overlap? So coming back to where a couple slides ago, at closing, or the day, I like having closings in the morning, and then the afternoon you can go back. Seller closes your accounts that day and over the next couple days. So you call Penn Vet, you call Miller Vet, MWI, etc. I need to close my account. Here's an address for the final invoice. Oh, hang on, somebody needs to talk to you. Hi, I need to open up an account. And that happens. Most of the vendors and suppliers, that it's the close and open. There are some that transfer. These tend to be long-term relationships that you're just calling them up and say, hey, there's a new owner. For example, X-ray badges, security systems, service maintenance agreements, website hosting. Those tend to just transfer from one to the other. Utilities, close open. Insurances, close open, except for your professional liability insurance. If you are not going to continue working, you don't want to, I don't recommend that you close your professional liability. Instead, and your agent won't be able to help, it's called a tail policy, because on the graph, the coverage decreases, looks like a tail. So it keeps you covered and it's less expensive, it decreases over time. So a tail policy would be the thing to transfer. Holistic practice, hard to sell. Not hard once you have a buyer. Then it's easy peasy like everything else. Same with a house call practice. The challenge is finding the buyer. All the variables into account are sellers just as happy selling to another vet as they are selling to a corporation. Boy, that's a loaded question. Anecdotally, the clients with whom I work, selling to an individual, selling to a corporation, it's what are your goals? And if your motivation is your goals, I want to sell and I want to leave. Okay, fair market value. I want to sell and I'm happy to stay. Oh, maybe corporate and fair market value. Let's find the right buyer. And when you're doing it for the right reasons, and we set things up correctly, if you want to stay and work, we build that into the process. Maybe you only want to work 2 days a week. The doctor I reviewed the letter of intent with tonight, they want 2 days and it's asking for more. So we're going to negotiate that. But when you set everything up to meet those goals, you end up with win-win situation all the way around because it's fair to all concerned. I do hear the anecdotes and the horror stories that things don't work out. And then my first question, was it for sale by owner? Because somebody tried to do it yourself. It can work. A lot of practices transact that way. But the horror stories you hear, it's usually that scenario though, because they're missing some of the details. What are the best facets to add to a practice if you're trying to build value? Woohoo! Exam room, more client volume, etc. Yes, increasing your service revenues, not increasing fees. That can cover up systemic issues. That's putting a Band-Aid and hiding the wound. But trying to do more with what you have. This is a fixed cost business. What I mean by that, the majority of your expenses are fixed. If you think about it, if you see one more dental procedure that day, what have your expenses changed? Drugs and doctor. That's it. Staff didn't change, rent didn't change, insurance didn't change, just drugs and doctors. So how can you do more? How can you get one more pet in and practice more medicine, work a little more efficiently? That's where value comes from. Because as a fixed cost business, the more you can do with the same expenses, same assets, the more profit you're going to generate, the more pets you're going to take care of. So the pet wins, the pet owners win, the practice wins, your team wins, all the way around. The three main areas for growing a practice, underserved areas: nutrition, oral health, and cats. All three of these, though, require education and a client relationship. So it takes a team to bring those in. Nutrition, so many obese pets. Oral health, I drank the Kool-Aid on that, most definitely. And the number one thing you can get your team to stop doing to make that better is stop using the word dental as a noun. It's an adjective. Dental procedure. Let's bring your pet in for a dental, belittle some medicine that's involved. Dental exam, dental treatment. And then on the cats, I had one client, they closed on Wednesdays, actually it's Thursdays at noon, super clean the hospital, turn the lights down low, add in some music, heat up the blankets, reopen at 1. From 1 until close, it was cat only. And it took a while to catch on, but then it was booked out. So cats are just underserved in general. And I think those are three really important. Any difference in single versus multiple doctor practices? Certainly the corporations, they're looking for size, stability, and location. And location now is starting to play a role too. I had corporations say no to a practice that had size and stability because they didn't think they could hire doctors. So geography is starting to play a role in that a little bit. But the stability component, they prefer 2, 3, 4, 5 doctor or more practices because they don't have a stable of doctors they can just put one in your practice. So more doctors you have, the more you become a potential corporate target. I have sold solo practices to corporations. It's just less common. But multiple, I had a practice that was grossing 3 million, or no, it was grossing 4 million. It was worth 3 million. And the owner said, I could have said, I'm selling it to my associate. And I said, that's fine. We can definitely do that. But just so you know, I could sell this to corporate for 8 to 10 million. They said, nope, I'm selling it to my associate. Okay, and we did. So that's coming back to what are your goals? What do you want for your practice, your team, and your community? If your goal is to sell and get out of town, you might have different options than if you're staying in town, you're going to hang out, you're still going to be a part of the community. How does bringing in a partner work? So in a buy-in, now we could spend an hour on that, but a buy-in is different. We're still going to start with the practice value. And then we're going to look at the entity value, like I talked about in the first section, adding in the checking account, at least the amount that's transferring, subtract the liabilities. Determining the price is just the first step. The second step, the purchase agreements are easy. They're just buying an interest or shares in your practice. The most important document when you have multiple owners is what's called the operating agreement. It's also called a buy-sell agreement, a shareholders agreement, partnership agreement. This is hugely important, and I strongly recommend working with a veterinary attorney. This is your playbook, how you're agreeing to own the practice, how you're going to pay yourselves, all the what ifs. What if one of you dies? Does that trigger a buyout? Do you have to work in the practice? Or if you're an absent owner, does that trigger a buyout? I would love to own any of your practices. I'll buy 10%, and I promise never to say anything unless asked. Just give me 10% of your profit forever. No, you wouldn't do that. So that operating agreement plays a big role, and that veterinary attorney can guide you through that process. A buy-in and having multiple owners, when done correctly, can be terrific. But it's recognized it's only about the money. Marriages fail, and there's supposed to be love involved with that. In a buy-in, that partnership is about the money and a common vision. So just as hitting that really quickly. Scanning all the questions here. I did mention walking through evaluation. There's still folks here if you're interested in doing that, and we can still give time for questions. But here's the one I had mentioned. Let me get that set. So in this case, we had a practice, a mixed animal practice with two owners. They had an associate that was a keeper. You know, if you're out fishing, you don't throw it back. So, and they decided, hey, let's value the practice. We might do a buy-in, and we want the management feedback as well. So we started with, now normally when we value a practice, we're looking at 3 to 5 years. Right now we're looking at 4 because of COVID. We want 3 good years and then COVID. But in this case, this practice is grossing almost $850,000. We removed the non-operating income, didn't have anything to do with their practice. We adjusted the owner compensation, and you can tell the owners, that's 2 of them, they were part-time. Adjusted owner management compensation, adjusted payroll taxes. On the bottom, we put in a rent because they didn't charge themselves a rent. They owned the real estate. Removed personal insurances, removed one-time expenses, made these adjustments. This practice was 15.8% profitable. That's good, financially healthy practice. So perfect, we've got our financial data. We can review it across the years to determine the proxy for the path forward. And we go, now we take the next step and go into the value. So we look at the income approach. And this is one of those details, 5 times the bottom line. It's not 5 times the bottom line. Because if you take 5 times the bottom line, you're getting last year's value. The single period capitalization, when you capitalize, you first have to grow the profit, whatever that benefit stream is, out to next year. Because the valuation is prospective. So the process actually starts, we take their profits, we grow it by 1 year, stable long-term growth rate in perpetuity, which is usually 2 or 3%. Then we capitalize it. In this case, this practice cap rate was 20.2, so just under 5 multiple. And we have the value of $681,000. Then we go to the market database. We have our reference, and we found 17 transactions. This is price to earnings, price to gross. So you can see the mean and median, pretty good distribution, especially on here. So we can decide, well, let's take the mean price to earnings times the earnings, we get the value. We can weight these based on confidence. Usually we don't put a lot of weight in the price to gross. We have the value of the practice. We can then have the reconciliation, and we look at both values and weight them. In this case, we gave the income approach more weight, one, because it's driven in the numbers, the financial data and the return. And number 2, the market approach, most of that's small animal, not mixed. So it's valid, but we didn't feel it had significant contribution. That gives us the value, 677. Before we conclude that value, we do 2 reality tests. So we look at a hypothetical transaction. Would the lender approve it? The lender approval, assuming a creditworthy buyer, their approval is based on the earnings relative to the debt service. Does it hit their target ratio? If it does, they'll loan the money, fair market value. A hypothetical buyer, if I bought the practice for $677,000 and I run it next year as it was run last year, I'm going to get the profit. Will the profit pay the debt and pay the taxes? If it's true, fair market value. If either test is too true, value might be low. And if it's not true, the value is too high. So that gives us confidence in our conclusion. In this case, they were happy and thrilled. They moved forward with the buy-in. However, the diagnostic component, their profitability had been decreasing. 3 years ago, it was 19%, and then 17%, and now 15%. Their inventory expenses had been creeping up and no one knew. And so we were able to give them that feedback, and they were taking steps. I think we're going to be valuing their practice later this year, actually, to get them the update. So that's kind of an overview of how that process happens. What about corporation interest in a small house call practice? Probably not. However, there's always exceptions. One of the things to think about, do you have a practice nearby that's a larger practice, or maybe a larger practice owned by the corporation that you could do a merger? So they buy you, bring you in, you go with them, you agree to work it, and then transition it. So they're going to take some of their doctors and take turns doing the house call portion. It's another way to grow. So you think creatively, and that's where a broker in your area can probably help kind of walk through some of those options, because we've seen so many variations. And I had a similar discussion with somebody just this week on that. Can a merger that's an absorption of one practice by another garner more than 100% of gross as the profit transferred? It depends. So in a merger scenario, the acquiring practice can operate that your revenue. So if I'm buying your practice, your revenues, I can get more profit out of than you can. So that might have a higher value, but it depends on the numbers, and it depends on the negotiation. Even though you can demonstrate, and we can do the math, that yes, a higher value supported. I have had the acquiring practice owners say, I get it, I see it, I'm not paying it. Well, now we have to negotiate it. I often see earnouts applied in these scenarios. So let's say your practice is grossing 500,000, it's worth 300,000, and I'm going to do a merger, and I say, yeah, I'll give you 350 for it. I'll pay you 200 at closing. 12 months later, if my revenues increase by that amount that you say I'm going to get, I'll give you the extra 150,000. So that mitigates some of the risk on the acquiring practice, and it keeps the seller motivated to speak well of the buyer, to encourage clients to go there, maybe work there yourselves. And there's a plan to doing a merger. You want to transfer the website, the phone number, client letter, and everything like that, really creating a package. But when done right, they can go really well and be very successful. Although I am running into, especially right now, where we reach out to all the practices in the area that have a similar standard of care, same geography, and they say, I see this. This looks great. I'm too busy. I don't want those revenues. And that creates a problem potentially as well. Are veterinary appraisers nationwide or need a local one? Veterinary appraisers, we can work throughout the nation. I just finished the evaluation down in the islands. I've got one actually right now in Hong Kong. The appraiser doesn't necessarily have to visit the practice. Traditionally, I do visit every practice that we value. However, since COVID, if I want to stay married, and I do, I'm not traveling. I got my first shot yesterday though. So I'm going to start, I've got about 100 practices I still need to visit, but that's not necessary. We can work from photos. We can work with video walkthroughs, a Zoom chat type event. I like to see the space, but you can work with, and a lot of my colleagues, Leslie Mamalis, Summit Veterinary Advisors, Denise Tomlin, Karen Felsen, I'm tied to my geography, but other folks work nationally. And that's true for most veterinary attorneys, as well as the veterinary accountants. I mentioned that the rent should be about 8% return on the real estate value. Yes, usually in most communities, we look at 8, 9%. Some, if there's high value, high rents, we might have to use 10. But then the follow-up question is on the real estate value based on a generic value. It's the value of the real estate's the value of the real estate. So veterinary real estate's not worth more because it's veterinary, unless it's new construction. Because new construction, you have all the extra costs of sound insulation, positive, negative airflow, extra plumbing, extra electric, lead line walls, etc. But by the time it gets depreciated, age-wise, that extra value ends up going away, and it ends up being similar to other professional office space. Now, the wrap up on that question was heard that rent as a percent of revenue ends up being 6 to 8%. Usually we see 4 to 6, maybe up to 8% of revenue. However, you don't set a rent based on the revenue. That penalizes the practice for growing. So you set the rent based on fair market. Ideally, it would be 4 to 6, maybe up to 8% or less. When it gets up to 9, 10, 12% of revenue, it's suppressing the value of the practice. The real estate's just worth more. What that means is the practice has to grow, or you just have to accept that you've got a lower practice value because of the location. Do you have to, within Simmons? Yes, we do not fish in each other's ponds. So I talk with people, I speak nationally, and I take phone calls and emails from everyone throughout North America, but I can't work with you. That's why I love teaching, because it's not about me, it's about helping you and teaching and learning on that. So another one in the chat, pros and cons of retaining the real estate of selling to a corporation. Corporations do not buy real estate. So most of the time you end up being the landlord. Now it's a triple net lease. So the tenant's paying almost everything, minimal exposure, and you get that solid benefit stream. However, if you want to sell both, you can. There are third-party real estate purchases, such as Vetly with Zach Goldman, TerraVet. Well, they will purchase the real estate coincident to the sale of the practice. You can negotiate both separately. With some corporations, they'll just take care of it on their side. So there are options. Some of it does depend on your real estate. If you lose that tenant, can you find another one? And if you can, then that's fine. That's perfect. A corporation, they're not going to intentionally move. When Dad sold his practice corporate, he had a tenant there for 19 years. When they moved, that's fine, because now he's got a fast food restaurant as a tenant. So that's a nice benefit stream. But there are others, you know, if it's going to be hard to sell or hard to find another tenant, then it might be better to sell the real estate now. I think we're hitting all the questions. Oh, there's some more down here. I didn't scroll through. How do you value practice goodwill? That's a good question, a fine-tuned point. When we value the practice, the value is not the sum of the parts. We're looking at the whole. The whole then includes the furniture, fixtures, equipment, the inventory, a non-compete covenant, and the goodwill. We back into the value of the goodwill because we start with the inventory. How much inventory do you have? Normal level. And then the value of your furniture, fixtures, and equipment. This is not an insurance value, it's a resale value. As if you sold everything, what would you get? Non-compete covenant, usually $5,000 or $10,000. The goodwill is everything else that's not in those categories. In a financially healthy practice, this can be 80, 90, 95% of the value. However, it can also be zero. Every practice has goodwill. Goodwill, that's your name, your reputation, blue sky. It's when I scoop up my pet and I leave, how likely am I to come back? But goodwill only has dollar value if it produces a return. So if your practice is worth $100,000, well, by the time we take inventory out, there might not be anything left for goodwill. You still have it, it just doesn't have dollar value. So in valuing the practice, we look at the whole and then break it into parts if we need to. Next step, there's a good question. Next step, if you want to sell, have your practice valued. I'm a fan of making decisions based on the data. If you find out your practice is worth 30% of gross revenue, you might choose a different timeline than if your practice is worth 80% of gross revenue. And I've had practices at both. In fact, I was working with an evaluation here this afternoon. Gross revenue is over $800,000. Negative 2% profitable. Negative, no profit. So the technical value of that practice is furniture, fixtures, equipment, and inventory. Now there's a little bit more, but that practice might be worth, as a startup, a jump start on a startup, maybe $200,000. Well, that might change your timeline. So starting with evaluation is the best way to go. Something that's reliable, not Bob's Appraisal Shack, because you're making significant decisions on this. Couple thank yous. I'm glad this was helpful for everybody. I believe that it is being recorded, but email Stacy and she can connect you with the link, because I don't know. I apologize. Demographic changes with COVID and people moving out of cities have increased revenues. How do you consider this type? So a quick comment on COVID. For a lot of practices, they're just growing gangbusters with COVID, crazy busy in spite of curbside and everything else. That can increase value. The question becomes, how sustainable is that? Other practices have been impacted. That doesn't necessarily mean the value has died. It depends on what's happening on a month-to-month basis. If the practice, yes, it took a hit, March, April, May of last year, but then since June, if it's slowly June compared to June, July to July, August to August, if it is recovering to normal, then we may treat 2020 as an anomaly and exclude that from consideration in the value. So that's why we're looking at 4 years trying to pick that up. It is being recorded. Stacy said she's going to send out the link to everyone if you're not looking at chats. Can a merger only be worth 4 times multiple because it's not guaranteed transfer of clients? A merger, it depends. Depends on what's negotiated. Yes, there's some risk, but we actually build in the math. We say, what if 60% of clients transfer? What if 80% of clients transfer? What does that mean to the profit to the acquiring practice? And by using the data, we can come up with a price, because it's not a set price when it comes to a merger. It ends up being what's negotiated. I think that's hitting everything. Hoping to sell in 5 years, would it be good or bad to transition from a sole proprietor to an LLC or an S Corp now? Great question. I think yes, for 2 reasons. Number one, you've got the tax side, and certainly you should talk with your accountant on that decision. But the second reason, and the reason most people do create entities, is the liability protection. If you're a sole proprietor and I sue you, I have access to everything you own. Now, you're the sole proprietor, you own it personally. I can pursue everything personally. If you have an entity, I can only pursue the entity. As long as you're treating it like an entity, recording things, filing things, meeting with yourself annually, etc., I can't get through that entity to you personally. So for 5 years, I would say yes, but with the caveat saying talk with your attorney and your accountants about that. Are most buyers okay with the seller doing relief work in the same area? That's another good question, and one I had in reviewing the letter of intent. Oftentimes you can build into the non-compete covenant an exception for relief. However, how that's worded can be, you got attorneys that like words, right? If we say, yes, they can do relief work, but not to exceed more than 4 times in the same practice in a 30-day period. That sounds good, right? That's every Wednesday. That's a part-time job. So trying to word how much relief, one of the ways I put that in, though, in a non-compete covenant is at the beginning, it says seller agrees that for the next 5 years, seller will not, without buyer's written permission, do any of the following. That way you can say, hey, so-and-so wants me to cover the shift. Their aunt died. Can I go in there? And the buyer she says, yeah, that's not a problem. Great. You can violate the covenant because you have permission. So that's a nice workaround. For those who are a little loose on cash deposits, how many years before we should come? What I recommend, it depends on the amount. For example, I had one practice. I valued this practice, mixed animal practice, and profit was low. Diagnostically, I looked at it and I said, well, it could be any of these reasons, but I think your revenues are low. How much do you discount? And he said, well, you don't report to the IRS, right? And that's when I go, la, 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 la. I said, no, I don't. So I take out $200,000 to $250,000 a year, cash. I drop ship to the food lot, food animals, and they pay me in cash. I take it home. 5 times the bottom line, 5 times 200,000. That's a lot of value. In that amount, what I recommended, well, start putting it back over the next couple of years. Get 50 in, get another 50, 75 in, et cetera. Because it's going to bump things up. You don't want to catch attention. But if it's 5,000 a month or something, you can just start recording that in the year before, a year or two. But have that explanation so that you can, and do disclose to your appraiser what's going on. We don't report to the IRS, but we need to understand it so we can correctly find things. Comment on a no-low practice. Yes, so most definitely. A no-low practice is a practice that has no or low profit and thereby no or low value. A practice that has profitability of 9% or less is what we call a no-low practice. It's not a judgment call. Usually these are great practices. They're just not financially healthy. They're plagued by diseases. So for a buyer, that's a great opportunity because you're getting a great practice at a price based on what it currently is, but you have the opportunity to fix it and improve it. If you are a no-low practice or suspect you are, I do think starting with that valuation for management and planning purposes, because then you can get the feedback. However, if you want to take a shortcut, the number one disease that plagues veterinary practices is inventory management. It's your cost of goods sold. Otherwise called cost, I call it cost of professional services because you're not selling goods, you're professionals. It's synonyms: drugs, medical supplies, pharmacy, lab, reference lab, in-house lab, parasiticides, pet foods, burial, cremation. In a small animal practice, typical small animal practice, that group of expenses should be 22 to 25% of your revenues. The practice I mentioned that was negative 2% profitability, 32% of revenues. Whoa. Well, we just found 12% of revenue that's not getting to the bottom line because it's tied up in that cost of professional services. Fix the inventory management, you're good. Of course, that's easier said than done, right? Is the problem with ordering? Is the problem with markups of products? Is the problem, maybe those are fine and it's service fees? Is it discounting? Is it missed charges? Is it theft? You're ordering everything, but it's walking out the back. Any and all of those can drive that up as a percent of revenue. So we don't know why it's high, but if you suspect you're a no-low, I would jump in and start learning more on inventory management. Denise Tumblin's written a lot about that. Marsha Heinke's book, Practice Made Perfect. It's a little pricey, but it's a very good book. And she's got a lot of good information on there. BHMA website on inventory management. There's a lot of good stuff out there that can help you. I think maybe that hit the questions. Well, there was one more. Corporation, how long do they want you to stay as an employee? Prefer a year. It's open to negotiation. However, the longer you're willing to stay, the better things can go. If you don't want to stay, so here's a scenario, a practice I sold at the beginning of the year. Practice is grossing $3 million. Its fair market value is about $2 million. I sold it for $6 million. The seller left because in the year prior to putting it on the market, the owner backed themselves out. They weren't producing. So all the other doctors were doing it. The buyer said, "Oh, employment contract." No, I don't work in the practice. Oh, okay, goodbye. Exit planning, right? If you know you want to go corporate, but you don't want to stick around, plan the exit, back yourself out, manage the associates. And that way you don't have to stay. You got a practice manager, all the doctors, you're golden. So that's in the planning. So it looks like we are set. So I'm glad a lot of folks stuck around a long time because that was 2 hours here. So I'm glad it was worth your time. I hope it does help with your next steps forward. Stacy is going to send out the link. It'll be on YouTube. The other one's on YouTube as well, so you might be able to catch both for the buying side and a little more on value. Because they're future owners, they really need to understand more. Certainly welcome to send an email for a copy of the presentation, some additional reading information, and with questions, etc. So appreciate the time that you gave tonight, and I hope it helps.